Hello, everyone. As part of our conversations here in this Tuesday, we have the great pleasure to talk to Professor Hendrik Bessembinder from the University of Arizona. And this is part of a long tradition we have here during our anniversary celebrations, where we usually invite professors or some people that represent the academic field to talk to us. We love the school, like that explains part of the origins of Empiricus here in Brazil. Me and Felipe, our dream was to become professors, university professors. We couldn't do it, but we can talk to other professors, and that's fine by us. And so we already received in previous years Professor Daniel Kahneman, Professor Richard Taylor, Nassim Taleb, and now we have the pleasure to talk to Hendrik Bessembinder. I'll make just a brief introduction. Of course, the main interest here is to hear the professor and not me. And I would like to explain what exactly caught my attention in the work of Professor Hendrik recently. And the first thing is that we document in the financial theory a phenomenon which is generally called the equity premium puzzle, which is basically a premium that you would expect from the performance of stocks over fixed income, over bonds. And it's not very well explained by the literature. There's much discussion about it. And one thing that is very clear to me is that, and Professor Hendrik has called the attention to that, is that you shouldn't take the equity premium for granted. I mean, of course, you can observe this in different time frames, that stocks outperform fixed income, but the condition for that premium might be very specific, with very specific characteristics. So it's not a phenomenon that occurs by osmosis, let's say. And one aspect that I find very interesting in one of the papers that was produced by Professor Hendrik is that the return, long-term return of equity is strongly positively skewed, the distribution of returns, right? And that's a very important characteristics of why or meaning how equity performance is better than fixed income performance. That's the first point. And the second point is that even though stock returns are strongly concentrated on just a few stocks, and that doesn't mean that the story of those top performing stocks is a romantic story. It's also a story that's full of drawbacks, setbacks, and the investor can participate in that story in very different manners, psychological and financial manners. You can lose a lot of money by investing in Amazon. It's not trivial, it's not obvious that you're gonna be rich, even looking back. And so I'll give here the word, pass the word to Professor Hendrik. And then after his explanation, if we have time, we'll continue on some Q&A. Thanks a lot, Professor.
Well, Rodolfo, thank you very much for involving me in the conference. It's a pleasure to be involved. It's a shame that this year we cannot include a visit to Ipanema Beach, but maybe next time. All right, I hope everyone can see my screen. As you see, I titled the talk "Some Surprising Facts About Long-Term Stock Returns." Rodolfo's given you a preview of some of the surprising facts, but let me show you a little more detail. So, as an overview of the talk, I'm going to present some findings from a series of studies that I've been doing about the properties of long-term returns to stocks. There's a lot of other studies out there about stock market performance, but most typically what the studies do is compute returns over short intervals like monthly, and then take averages. And one of the points I want to make is that this typical method actually obscures a lot of information about how stocks behave and how they reward investors in the long run. I'll show you some data from a large-scale study, 64,000 stocks, 43 countries over the last 30 years. Then also, as Rodolfo foreshadowed, talk a little bit about how the road can be bumpy, and it is bumpy, even for the most successful stocks. If you're interested, these papers and the related papers can be downloaded from ssrn.com free of charge. So I want to start with just some graphs because many times a picture can say a lot. So this is the sample that has 64,000 common stocks over 30 years. And this is just a frequency distribution of the monthly returns. I broke it out separately for US stocks and non-US stocks in the sample. And I'm putting this up mainly for the contrast to what we see when we look at longer horizons. But the main thing I would draw your attention to is that while this distribution doesn't exactly look like the normal distribution that you see in books, it is pretty symmetric, especially, I think you can see my cursor on the screen. It is pretty symmetric, especially in the range where most of the observations are. So the next thing I'm going to show is returns computed over decades. And all I've done is taken those monthly returns and compound them within a decade. So same sample, same data, just compound the returns in a decade. And here's the frequency distribution. And I think it's safe to say it doesn't look anything like the monthly distribution. It doesn't look anything like a normal distribution. In particular, the most frequent outcomes, modal outcomes, if you prefer the statistics, are down near negative 100%. There's no hump in the middle. And then there's a few cases that are very high. I have the graph truncated at 900% or a multiple of 10 times. But there's a fair number of stocks delivering a multiple of 10 times within a decade. This next graph is same general idea. It's just I've compounded returns for the full sample. If the stock was there for 30 years, it's its 30-year compound return. If it was there a shorter time, it's its shorter compound return. And again, same punchline. That doesn't look anything like the monthly returns. Doesn't look anything like a normal distribution. So the word is skewness. I have not been using the word skewness in the title of my papers because I fear it might scare off some people who actually should be interested in what's in the papers. But the papers are really about the skewness in long horizon returns. So that's what the graphs illustrate, is that there's a lot of positive skewness in the distribution of compound stock returns. In a skewed distribution, the mean is greater than most individual outcomes. In particular, it's bigger than the median. So the next thing I want to show you, we take each of those 64,000 stocks, compound their returns over their full period in the database. Now for some that's a year or two, for some that's all 30 years. And then just compare it to some benchmarks, like is it positive? Does it beat the US Treasury bill? Does it beat the average across all the stocks? All right, so a little data dense here, and we don't have to focus on every number. If we take the full sample with the 64,000 stocks, so we've computed a full sample return for each stock. All right, the mean, the average across all the stocks is 290%. That's just another way of saying there is a positive equity premium, and when compounded out, it's a big number. But notice the stark contrast, that the median return is negative. When I first did computations of this type, I was quite taken by surprise by the huge difference between the mean return and the median return to stocks over long horizons. So of course, with a negative median, that means less than half are positive. And then as we raise the hurdle, of course, the success rate declines. So in this really very broad sample, only 40% of stocks outperform US Treasury bills, which we, in finance academia in particular, we tend to think of the US Treasury bill as the closest thing there is to a risk-free asset. So there is a premium to investing in stocks, but it is not found in a typical stock. And that's the nature of the skewness. Very large outcomes for a few stocks are driving the equity premium. And then this last column, again, just another signature of a positively skewed distribution. Most of the outcomes are below their own average. All right, so I've got global. We take global excluding the US. The results are very similar. My original study was a US study, so that's why it's worth making the point. It's not just a US phenomenon. I have subsamples, which I won't spend too much time on. Let's drop down to Brazil. There were 387 Brazilian stocks in the study. Compound their returns and then take the average across stocks. Very nice number, 307%. But in Brazil too, the median stock is giving a negative return, compounded, and less than half of stocks are actually delivering a positive return. So what I just showed you was, I think I used the phrase compound returns. These are sometimes also referred to as buy and hold returns. I just want to contrast what you get with buy and hold returns to what you get if you look at the simple arithmetic average. So, sorry, wrong button. So I showed you buy and hold returns, which reflect a trading strategy, a passive trading strategy. All right, those turn out to be big numbers because a lot of time has gone by. The geometric mean, which many of you will have dealt with before, is the number that if you compound, gives back the buy and hold return. All right, we have alternatives to that, including the arithmetic mean. It's the simplest thing in the world. Just take all the returns, add them up, divide by how many there were. It also has a trading interpretation. And then I threw one more in here. It's not the main point, but there is another way of computing long-run returns, and it is discussed from time to time in the investment management, fund management literature. That's the idea of a dollar-weighted return. So as applied to an individual stock, what the dollar-weighted return here, the trading interpretation, is that you trade as necessary to maintain a common percent ownership. And buy and hold doesn't do that. You have to participate in equity offerings. You have to participate in share repurchases. The reason dollar-weighted returns are of some interest is that this is what the body of shareholders in aggregate earn. But the main reason I wanted to show you this is to show how misleading the arithmetic mean is, the simple mean. So what I've done is for every stock, computed its full sample return as the arithmetic mean, the geometric mean, or the dollar-weighted return. So in the global sample, 64,000 stocks. So we've got an arithmetic mean return for every stock. Then if we say, what's the median across stocks? With the arithmetic mean, it's almost 1% per month, which is a very nice number. But the geometric mean, which is the one that actually compounds into the buy and hold returns, is negative. And the dollar-weighted mean, the dollar-weighted return, which reflects the actual experience of shareholders in aggregate, has even slightly more negative median. So it holds for the global sample, holds for the subsamples. It holds in Brazil as well. So again, the main point here is that focusing on arithmetic means as a way of assessing long-run shareholder outcomes is highly misleading. I also computed something in this series of papers that I labeled wealth creation. Let me clarify what the measure is. So it's the shareholder's wealth at the end of the sample as compared to the wealth they would have had if they had earned US Treasury bill returns. So essentially, it's what we would call a risk premium, ex post, after the fact. It's what investors actually ended up earning as a risk premium, but it's measured in dollars as opposed to percent, as these things are often measured. It's essentially how much of a reward did investors in aggregate actually gain because they took on the risk of stock market investing. The measure, it does consider, of course, the final market capitalization at the end of the sample, but it also takes into account all of the earlier cash flows, all the dividends that were paid in prior years, any share repurchases in prior years, as well as share issuances in prior years. So it's an attempt to capture everything that affected shareholders in one number measured at the end of the sample. So if I compute this wealth creation number for each firm and then add it up across all the 64,000 firms, and I'm going to call that net wealth creation, it's a big number, measured in US dollars, $56 trillion over the last 30 years. If I add that up across all of the firms where it was positive, and I'll call that gross wealth creation, the number is just under 80 trillion. So by implication, the firms that destroyed wealth destroyed about 23 trillion in wealth. All right, seems everybody likes lists of big winners. So these are the 20 individual companies that have created the most wealth for their shareholders by this calculation over the last 30 years. It's a little bit obvious that American firms tend to dominate the very top of the list, with Apple, Microsoft, Amazon, and Alphabet in the first 4 spots. And really, I think, dramatically large numbers. Apple alone responsible for increasing shareholder wealth by just under $2 trillion. Among the non-US firms here, Switzerland's well represented with Nestle and Roche. Tencent is the best performing non-US firm on the list. And one other thing I want to draw your attention to before we leave this. So Apple created almost $2 trillion in wealth for its shareholders in the last 30 years. That's actually by itself 2.5% of what I computed for the full sample of 64,000 firms. 2.5% of the gross number, or 3.5% of the net number. Then you add in Microsoft, and the two of them together account for almost 5% of the gross wealth creation, or 6 2/3% of the net wealth creation. As you see, this accumulated percentage that's explained by the firms listed here is kind of large when you consider that there's 64,000 companies in the sample. The 20 firms listed here together are explaining 22% of the wealth creation globally. I want to come back to that point in just a minute. But everybody likes a list of big winners, so why not spend a minute on a list of the biggest, the most successful Brazilian stocks by the same computation. And I have to confess that I don't have an intimate familiarity with all of these firms myself. Some I recognize, for example, a famous mining company and a number of banks and a major retailer. But I thought for this audience, it might be of interest to see the list of the 20 best performing Brazilian stocks over the last 30 years. Now, if everybody enjoys seeing the list of the biggest winners, maybe we get a little bit of secret pleasure. I think the Germans call it Schadenfreude. So let's have a look at the firms that were least successful by this measure over the last 30 years. So PetroChina somewhat stands out by itself with $500 billion in shareholder wealth loss. It's very notable that the top half of this list has so many Japanese firms on it, and in particular Japanese banks. We should recognize, though, that in some sense it's a little unfair to Japanese firms that the study starts in 1990. That was by necessity. The database that we used was not broadly populated before 1990. We couldn't do a really broad global study with earlier data. But as it turns out, December 1989 was the all-time high point for the Japanese stock market. So it's certainly the case that if we had been able to go back another decade, the Japanese firms would have looked much better. Nevertheless, some really negative shareholder outcomes over the last 30 years with major Japanese banks. The other firms that end up on the very worst list, there seems to be a disproportionate number of telecommunications companies, WorldCom, ViaV. There's a typo there. That should be Lucent Technologies. Anyway, of some interest also to see the firms that ended up doing worst. But I'd like to circle back to this observation that wealth creation is concentrated. A large portion of the overall stock market wealth creation, which is these are truly large numbers, whether we focus on the net or the gross. 56 trillion in wealth generated for shareholders over the last 30 years. But the top 20 firms that were shown 2 slides back accounted for 15% of the gross, 22% of the net wealth creation. The top 50 firms, 24% of the gross, 34% of the net. And again, this is out of 64,000 stocks. So here's some more comprehensive data on how concentrated is the wealth creation. So again, the global sample, oh, by the way, you've heard me say 64,000. Now you see here 63,000. Distinction between number of stocks and number of firms, since there's a few firms that have multiple share classes. So it's basically 64,000 stocks issued by 63,000 firms. All right, so globally, 63,000 firms. These are the total wealth creation numbers that I mentioned earlier. All right, so over here, we focus on the top 1% of the firms. That is the 1% of firms that had the greatest shareholder wealth creation. So for the global sample, that's 632 firms. So 632 firms accounted for 63% of gross wealth creation and 90% of net wealth creation. If we leave out the US, 45,000, almost 46,000 non-US firms, 60% of the gross wealth creation, more than 100% of the net wealth creation. So another way to state that last finding is that when we go outside the US, less than 1% of the firms accounted for all of the market wealth creation over the last 3 decades. So the point that wealth creation is concentrated in a few firms, I mean, it's, I think, remarkably strong, the extent to which wealth creation is concentrated in a few firms. It's really the combination of 2 things. As we've already talked about, the distribution of returns is strongly positively skewed. The median return is not positive at all, but there's a few very large returns that pull up the mean. So it's the skewness in the return distribution combined with the fact that you have some big firms and some small firms. So to get a really big wealth creation number or a really big wealth destruction number, you kind of have to be a big firm. Anyway, it's the when we marry those 2 facts, that the return distribution is skewed and also the size distribution varies, then you get the remarkable outcome that less than 1% of the firms can account for all of the wealth creation. So I have other samples as well: developed markets, emerging markets, same general pattern. Somewhat more concentration for emerging markets than for developed, but very strong concentration in either case. And again, Brazil is not really an exception to the general pattern. Maybe things are a little less concentrated in Brazil than say other emerging markets, but 382 Brazilian firms. So the top 1% is four firms. So the top 4 Brazilian firms are accounting for half of the net dollar gain over the last 30 years, and 30% of the gain among those that actually had a gain. So Rodolfo mentioned it's not always a smooth ride. So let's delve a little further into that. Let's look more carefully at some of the big winners, some of the stocks that turned out to be big winners. So the results reported on the next few slides are actually from a slightly different study. This one was focused on US stocks, not global stocks. And it goes back further. We have a longer history of data available, but I needed some accounting data for some aspects of this study. So it starts in 1950. So I broke things out by decade. From 1950 through last year. And then what I did is picked out the stocks that created the most wealth for their shareholders within each decade. And then looked more carefully at what happened with those successful stocks within the decade and in their history. And the key insight is already foreshadowed. Even the big winners provided a bumpy ride for long-term shareholders, maybe bumpier than you might have imagined. So let's start with Apple. Apple ended up at the very top of my league tables, and through mid 2020 had created almost $2 trillion in value for shareholders. Here's a graph of Apple's share price. This has been adjusted for dividends and splits. This particular graph runs through the end of 2019. We know that would continue upward if we had a few more months of data. And at the big picture level, it gives the impression that well, things were just kind of smooth and uneventful until 2004. And then the stock took off, which is not entirely inaccurate. But if it's 2000, where you can barely make out this little bump in the graph around 2000, you didn't know that this was coming. You may have been optimistic, but you were living in 2000, and there was actually a lot going on in that little bump in the graph. So let's zoom in on the period from the turn of the century to mid 2003. Apple had a drawdown, an accumulated negative return. Apple had a drawdown of almost 80% from March 2000 to March 2003. And actually, if we focus on the shorter period, the 4-month period right here, 76% drawdown in 4 months. So imagine you had bought into Apple just before that drawdown, and then saw 3/4 of your capital disappear in a 4-month period. And that was not the only episode roughly like that in Apple's history. Apple had 2 other drawdowns that exceeded 70% in earlier years. Or let's look at Amazon, which was third highest on the league tables for overall wealth creation. Here's a graph of Amazon's share price from the time they went public through the end of 2019. Here, it's maybe a little more apparent that something was going on back around 2000. Let's zero in on what happened back then as the dot-com bubble was bursting. So Amazon's share price, they didn't have any dividends here, so I didn't have to make an adjustment. They had a drawdown of 91% in a 19-month period. Or if we go back just a little further to March 1999, they actually had a drawdown of 93%. If you had the misfortune to buy in at March 1999, 2.5 years later, you had 7 cents on the dollar left. I mean, that would have not been an easy period to endure or to explain to your investors. All right, so let's go a little broader beyond those two striking examples. So what's being displayed here is the largest wealth creation by firm and decade. So earlier I showed you full sample aggregated across all years. This is by decade. So this data is of some interest itself, I think. Like for example, here's Microsoft in second place for the most recent decade and also in fourth place for the 1990s. They had a difficult decade in between that I didn't highlight here. The most recent decade is heavily represented on the list of best stock decades for investors. But there are some interesting exceptions. General Electric in the 1990s. Sorry, I was looking for another example. Yeah, IBM in the 1960s turned out to be one of the top performing decade performances by a stock. Oh, and this is interesting. Lucent Technologies was one of the top performing wealth creators in the 1990s. And the reason that's of particular interest is that you might recall that they were also on the list of worst lifetime performers. So there is some sort of a lesson there too about past results don't guarantee future performance, as Lucent turned in this exceptionally good performance in the 1990s, but then ultimately destroyed more shareholder wealth than most firms ever have. All right, so these are the top performing firms in terms of wealth creation within a decade. And then what I did is said, well, let's look even within this highly successful decade, how big were the drawdowns? And I think I would say surprisingly large, that even within the decades where they turned in some of the best stock market performance in history, you're seeing drawdowns within that decade of 30–40%. The average for the top 100, not all of which are displayed here, the average for the top 100 is a drawdown of 32.5% over 10 months, even within an amazingly successful decade. If we go outside of the amazingly successful decade itself, of course, we find even bigger drawdowns. So the left side here is the same set of stocks and decades, the most successful stock decades for shareholder wealth creation. But now on the right side, it's how big was the largest drawdown in the prior decade. So there's Microsoft and Amazon events that we focused on a moment ago. And I chose them because they are particularly striking drawdowns for particularly successful companies. But as you see, it's not unusual to see drawdowns of 40, 50, 60%. So for the 100 best performing firms and decades, the average is that in the prior decade, they had a drawdown of 52% over 22 months. So you endured a loss of half of your capital at some point in the prior decade if you were a long-term shareholder in these companies. So I'd like to walk through what I think are the implications of this set of studies. And in all honesty, I'm still trying to think this through myself. What are the implications of a set of findings that seem to have surprised a fair number of observers, including me when I first started work in this direction. So we know that venture capital and early stage investments is highly skewed, to use the statistical term again. matter of fact, the very first time I made a presentation of these results, I started the talk by saying, I'm going to tell you about an asset class. And in this asset class, most investments lose money. The most frequent outcome is losing all your money. But there's a few of the investments that give very large returns. So much so that the asset class as a whole is actually a desirable place to invest in money making. And then I said, but you might respond to me, I already know that about venture capital. And then of course my punchline, academics are not always really good at humor. My punchline was, but I'm not talking about venture capital. I'm talking about public equity investments, public stock market investments. So we know this about venture capital. My point is that long-term stock market investment has the same characteristics. Most investments lose money. Most frequent outcome is losing all your money. But there's a few investments that do very well and make the asset class worthwhile. Why is this a surprise? I'll go out of my way and criticize particularly my academic colleagues who have been measuring returns over short horizons, like a month, and then computing the simple arithmetic means. That method of summarizing stock market returns obscures the reality of long-term stock market outcomes. So it's looking to me like this pattern. Losses on most investments, big gains on a few investments. It looks to me like that's a fundamental attribute of investing in entrepreneurial economies. Second, portfolio optimization. So if you're an investor without any unique insights, now hopefully that doesn't describe a large segment of our audience today, but it might describe a large segment of the population. If you don't have any particular insights, any particular skill in identifying stocks with good potential, these results reinforce the desirability of diversification. It's for every reason that's already in the textbooks, plus on top of what's already in the textbooks, diversification, broad diversification guarantees that those big winner stocks will be in your portfolio. And if you don't diversify, if you have a narrow portfolio, there's a very real chance that you'll miss the big winners. So for a lot of investors, the takeaway is diversification is good for all the reasons you already thought of, and here's another one. But I've been told by some colleagues at investment management firms that they've been at conferences and they've been in sessions where people on both sides of the active versus passive debate have both pointed to my paper, my set of papers. And I actually think that makes sense. In all honesty, I think the set of papers has some useful arguments for people on both sides of the active versus passive debate. So anyway, I do think this is an implication for, let's just say, non-professional investors. On the other hand, I phrase this for those who don't want to be restricted to broad index funds. More broadly, I don't think it would be a good world if everybody restricted themselves to broad index funds. I'm trained as an economist. I believe in the concept of comparative advantage. And I think some people have the comparative advantage in being active investors and should be to keep our markets efficient, to keep prices in line with value. In any case, a preference for skewness, that is a preference for the possibility of a really big payoff, can be rational. But if you diversify, you reduce the skewness. So my papers show there's a lot of skewness there, especially at long horizons. And the implication is that a narrow portfolio is going to be more skewed than a broadly diversified portfolio. So the results show just how big the gains to a concentrated portfolio can be. If either you're lucky or skilled, and of course that's the big question, but if you're either lucky or skilled enough to identify the big winners, the gains can be much larger than you would have thought if, for example, you were thinking that returns were normally distributed at long horizons. So that's kind of my last point. Concentrated portfolios, non-diversified portfolios, with stocks selected at random, they're actually going to underperform the market more than half the time. That's, again, the nature of skewness. Most observations are below the mean. And that's even if we didn't have management fees or trading costs. It's just the nature of a skewed distribution. So there are textbooks and websites full of tools for mean variance optimization. There's also the Sharpe ratio as a method of measuring performance. These are often justified by the assumption that the distribution of returns is sort of normal. We know they're not exactly normal, even in the monthly returns. But the assumption seems to be returns are nearly normal. And since they're nearly normal, we can focus on mean and variance of our portfolio, or we can measure performance with the Sharpe ratio, which is just a mean compared to a variance. But going back to those frequency distributions that I showed you, long horizon returns, the distribution is nothing like normal. So I think we perhaps need to be rethinking the desirability of mean variance optimization and the ways that we measure performance. And the last one, the last point that we made, even positions that are very successful in the long run are going to have periods of bad performance. Particularly concentrated positions are going to have periods of bad performance. And the more concentrated, the more likely it will be that there will be periods of bad performance. Of course, the big practical question is determining the difference between a portfolio that is a fundamentally sound portfolio that's going through one of these unfortunate periods that even Amazon and Apple showed us occur, versus those that are really not the right portfolio in the long run. But I think this point actually, as one debates the merits of staying with an investment strategy, I think it gives a little more ammunition to we should be patient. If we're confident in our strategy, we should be patient. I think it gives more weight to that side of the argument. So that's what I had put together as a planned presentation, and I think we do have a little time for questions if that's of use.
Oh, of course. Thanks a lot again, Professor. That was pretty impressive. And I was wondering here if you would ask any Brazilian investor if he or she would invest in a stock that delivered a drawdown of 93%. I mean, I don't know a single person who would answer yes to that,
Yeah, that's a tough experience to go through, but maybe quickly forgotten by the markets.
Yeah. Well, my first question takes as a reference the Eugene's famous hypothesis of efficient markets. And regarding that hypothesis, it's very hard to beat the market or to beat the index because markets are very efficient. But through your study, I would say that it's hard because markets are not necessarily efficient, but they are strongly skewed. want to hear your thoughts about it.
Sure. So I don't think there's necessarily a major contradiction between my findings and theories of market efficiency. I do think, there's a lot of debate about market efficiency and for good reasons. My own view is that the markets tend towards efficiency, but they're not completely efficient. Or I would put it differently. I'm not certain if the markets are efficient, but I do think they're really competitive. In a competitive market, you in some sense have to do better than your competition, who's also very bright people. So that's what brings me back to the idea of comparative advantage. I'm not sure that Eugene Fama would really would really disagree that there really should be some investors with the right comparative advantage to be active investors, and even that the economy, the financial markets need smart, active investors to that's the mechanism that pushes us towards efficiency, having smart, active investors. So I'm pretty confident that there are some smart, active investors, that these investors should have concentrated portfolios. The key, of course, is who. There's probably more investors who claim to be, let's take Warren Buffett as our benchmark. There's more investors who claim to be just like Warren Buffett than there are investors who are actually just like Warren Buffett. An analogy I sometimes draw, also relying on comparative advantage, should one try to be a professional athlete? In the US, I use basketball as my example. I guess today we should use football as our example. But should one try to be a professional football player? Well, if you have the right comparative advantage, the rewards can be tremendous. But what percentage of the population should be trying? I think there's an analogous question in asset management, and the skewness of the payoff shows something about how large the rewards can be to skilled investors. But how many investors actually have the right skill? That's the harder question.
Mm-hmm. I was wondering, Professor, I don't know if you have already studied that, but is the skewness of the market replicated in the skewness of fund managers?
Yes, I actually have another paper. So if you're interested, you can find it on that ssrn.com website that looks at U.S. equity U.S. equity mutual funds. And I think I mentioned earlier that diversifying reduces skewness, but does not eliminate it. So the distribution of mutual fund returns are also positively skewed, but not as much as individual stocks. Still, the key findings for individual stocks also show up for mutual funds, in particular, the percentage of mutual funds, when you look at their compound returns, the percent that outperform market benchmarks decline with the return horizon because the distribution is getting more skewed as we compound returns over longer horizons.
Right. And another curiosity I would have, I remembered when we first heard about a previous study made by Terence O'Dean, where he exposed a potential flaw from many individual investors, where the investor would sell positive return stocks and keep negative returns due to psychological reasons. And if you link that to a very skewed distribution, that is really dangerous, right?
Yeah, indeed. So there's an old joke that economists always have two hands. That's the case. That's the case here too. So on the one hand, I think we do need active investors, but we need active investors that are hard-headed and rational as far as is humanly possible. And we know that that investors and humans in general show numerous behavioral biases, and I think I agree that the very skewed distribution in combination with behavioral biases helps to explain why so many individual investors do poorly.
Right, and as a last question, Professor, we are to the last minutes here, and thanks again for your time and your very insightful presentation. Is that I remember by reading your paper that not only the distribution is highly concentrated, but it appears that it has increased concentration over time. I want to hear you about it. Why do you think that's the case? And if you think that's like a continuous phenomenon looking forward?
Excellent question. So first, it is true that the degree to which wealth creation is concentrated in a few firms has increased in recent years. That's yet another paper that's available on the website where I break things out for 3-year periods all the way back to 1926. And it is getting more concentrated. Now, why is that? I can only offer conjectures as opposed to hard evidence. I think the internet is facilitating winner-take-all type outcomes, with Amazon being an example. The second thing, and I don't know if the debate in Brazil is quite as active as the debate in the US, but there's concern that some industries are not as competitive as they were in prior years. And of course, to the extent that an industry is not competitive, you tend to see things like higher profit margins, and we do see evidence of higher profit margins in many industries. So while I'm not always a big fan of government intervention, I think a careful look at whether goods markets, the product markets are as competitive as they could be, would not be such a bad idea. The last part you asked is, will it continue in the future? I'm not sure if we'll have a continued increase in the concentration, but I feel completely confident in saying that outcomes will be concentrated in the future. This positive skewness of longer horizon returns is so universal and actually so easy to motivate with just the mechanics of when you compound random returns. I feel very confident in saying that we will continue to see a skewed outcome with a few big winners in the years ahead.
Perfect. Well, I'd like to thank you again, Professor. It was a great privilege for us to have this conversation with you. I'm quite sure that our audience took big advantage from your insights, and you will be more than invited to visit us, and maybe in Ipanema when the lockdown is abolished. Thanks again.
All right, it was my pleasure, and thank you again for inviting me.
All right, see you.
See you.
Bye-bye.
Operar é uma paixão. É aqui onde você finalmente se encontra. A sensação única que te faz sentir vivo de verdade. O mercado se torna um campo de batalha. E ao alcance dos seus dedos, você vai encontrar a melhor ferramenta para deixar a sua marca nesse combate. Você vai encontrar o Profit.
Você está pronto para o que está por vir?
Colocar em prática as melhores ideias de investimento do Brasil.
Você, independente,
E o seu dinheiro também.
sua espera acabou. O maior lançamento do ano chegou.
Fique ligado.